So nearly 1 in 3 UK pensioners are losing a big chunk of their pension before their retirement, either down to unexpected market shocks or just down to poor planning. And by that, I mean we're ignoring multiple warnings as we face our pension shortfalls. We've also misplaced or forgotten about £31 billion in older pensions. Now, according to the PLSA, the UK is now facing a slow motion train crash for our retirement savings. And that's their words, not mine. So what if that's you after all your hard work and your sacrifice? What would it feel like to see years of careful saving wiped out just before you can finally get to enjoy your life? Well, there are ways to put safeguards in place to protect your pension, but also to reduce the effect and the risk of that happening. So in this video, we're going to look at some proven steps that have been created to protect your pension, to keep your money working despite the majority of what the financial markets might throw at you. Now, if you're new here and you're new to the channel, a very warm welcome indeed. Hi, my name's Simon, and I'm a chartered financial planner with decades of experience helping hundreds of clients as well as their families plan ahead with confidence by keeping a lot more of what they've earned. So one of the biggest problems facing all of us as we get between 5 and 10 years away from retirement is what happens if our pensions take a hit just when we need them the most. Now, it doesn't matter how much you've actually managed to save, but imagine watching market swings or poor planning erode your pension value just as your retirement begins, or importantly, soon after. That isn't just a fear for many, it's a reality that's happened before and is likely to happen again. But there is some good news, and that's by managing how and where your pension's invested. Also by reducing the risks of big falls happening close to your retirement. It's also about having the right cash buffers in place as well, and de-risking or taking less investment risk at the right time. If you can do all this, then you can bulletproof your pension portfolio and retire with a little bit more confidence. Now, asset allocation is simply how you split your investment across different types of assets, such as stocks and shares, cash, property, and others too. Now, this mix will determine how much risk you're actually going to be taking, as well as define your potential investment returns as well. Now, cash is safe within the FSCS limit, but you're also going to suffer from something called cash drag. And that means that by keeping too much cash is going to see slow growth, and also your returns are going to be minimal. You've also got some lower risk investments as well, such as money market funds, gilts or bonds, and these tend to have lower long-term returns, and they can be heavily impacted by inflation as well. Now, thrown into the mix, we've also got higher risk investments as well, such as stocks and shares, and these can really create more wealth over the long term, but they can also be volatile in the short term, and when markets fall, they can take an awful lot of time to recover. Now, in this chart, you're going to see the fall in the FTSE All World Index around March to May 2008, and it took about 5.5 years to recover until around September 2013. Now, for those of us with pensions where we are responsible for taking the investment decisions, the aim for us is to find a balance. We need enough growth to outpace inflation and last decades, but not taking so much risk that we could face devastating losses. Now, in 2025, with political and market uncertainty, the typical more stocks when you're younger, more bonds when you're older rule still holds true, but it does require a bit more finesse. Now, experts suggest that you should be gradually shifting your asset allocation towards more stable and income-producing assets the closer you get to retirement. And this is called de-risking. I'm going to cover more of that later in the video. Sorry to interrupt the video. Over the last year or so, many of you have reached out asking if we can help with solving some specific problems, particularly around your retirement plans. And I've spoken to a lot of you personally on Teams. The great news is that we can now scale this properly and efficiently, but we're going to need to cap this at just 90 new clients throughout 2026. And that's going to allow us to keep it personal, intimate, and obviously make the recommendations and give advice of the very highest quality. So please follow the link on the channel and we're going to be in touch with you very quickly. If you're not ready to take that step just yet, there's no problem at all. You can register an interest and join our newsletter. Now, one of the biggest risks that we all face as we get close to retirement is something called sequencing risk. And that is essentially the order in which investment returns happen. And that can make a big difference to our pension, especially when we're taking or drawing an income. So why is that? And that's because withdrawing your money in a market downturn is going to lock in some financial losses. Now, imagine retiring with £250,000 in your pension, and you've had an average investment return of 4% a year over 10 years, and you're also taking withdrawals of 2.5% a year, or about £10,000 a year, and that's rising with inflation. Now, I've got 3 charts here to show the effect of how investment performance can either help or hinder your retirement, and thanks to our friends at Scopic Research for these charts. So in this chart, you can see what happens when you get the good investment years first. You can see the opening balance highlighted in yellow and the sequence of the annual investment returns, as well as the withdrawals rising with inflation. And then the closing value after 10 years is £251,941. Now in chart number 2, we have one good year and then one bad year in sequence. So you can see that happening in the chart. And then we've also got a closing value of £236,175 after the 10-year period. So in the third and final chart, you can see why sequencing risk can really damage your retirement plans when we have the poor investment returns and the years first. So in this scenario, the closing fund after 10 years is just £209,316. Now that's an 18.5% reduction in your pension fund value, despite having the same average investment returns and withdrawing the same amount each year. And all of that is completely outside of your control. And of course, it goes without saying that you need to be careful with your pension withdrawals. You're going to need to adjust your income during these market downturns if possible. So if you're finding value in this video about building a bulletproof retirement portfolio, then give it a like and subscribe to the channel. And don't forget to hit the notification bell either so you don't miss any future content. Now, once you've done that, here is a very quick question. Do you think your workplace pension is safe, or do you think the value is going to be eroded by investment choices that you're not making? Let me know in the comments below. Now, holding a lot of cash in retirement might seem counterintuitive, but the role of cash in retirement is not about making money. It's about security and the ability to sleep at night, as well as giving you some additional flexibility. And that's because when markets plunge, and they will, having a few years of expenses in an easy access cash bank account means that you're not going to have to sell your investments at a low point. Now, this cash buffer is going to prevent something that we call pound cost ravaging. And that's when you're forced to cash out at a loss, which is going to be permanently damaging to your portfolio. Now, the general recommendation is to hold between 1 and 3 years of essential expenses and spending in cash, plus a separate cash buffer for any planned expenditure for the next 3 to 5 years to cover major renovations or holidays, replacing the car, or even helping the family. Now, this cash should be accessible quickly in an emergency, such as in an ISA, in an instant access cash account, or even a money market account. And many SIP providers offer these types of funds. Now, here's one that I've used for the last 5 years. And if you want to know the details, just text fund into the comments and I'll let you know what that fund is. Now, you also need to be aware of holding too much cash in your pension though. Yes, holding cash can shield your pension, but it can also naturally drag on performance, and it can delay sequencing risk, but it might not be able to eliminate it entirely. Now, de-risking means gradually reducing exposure to volatile assets like stocks and shares and increasing your exposure to safer assets like bonds or cash as your retirement approaches. And the idea of that, of course, is to protect your fund from large losses during the critical early retirement phase. Now, depending on your level of knowledge and experience and of course risk tolerance, the ideal starting point for de-risking should be between 5 and 10 years away from your retirement age, whatever that may be. Now, this is going to allow you to reduce volatility, but without severely impacting any potential future growth. Now, the practical de-risking steps are going to include gradually moving from growth-orientated funds into more income-focused or diversified bond funds. Now, you might be looking at high yield or high income funds as well, or even direct company shares, which are also going to pay you a dividend each year. Now, some lifestyle funds or even some target dated funds are designed to automatically shift the risk, the investment risk, the closer you get to retirement. But don't assume that your workplace pension default fund is going to do this according to your retirement plans, especially if you're looking to retire a few years earlier than expected. Now, recent data has shown that many default funds, especially for those closer to retirement, have actually underperformed their expectations, and they also may not align with your specific retirement age or your income needs either. Now, a report in 2025 highlighted that returns for default funds aimed at savers over the age of 50 was 4.91% a year. And that is lower than many consider acceptable for this type of investment, especially for those people who are close to retirement. Now, if you follow this channel, you'll know that about 90% of UK employees are automatically placed in their employer's default pension fund. Now, these default funds are designed for the average saver and rarely account for individual circumstances like actual retirement planning, risk tolerance, or even considering the size of your pension pot. So therefore, you're going to need to consider reviewing and possibly even switching these funds to more suitable options, especially if you plan to retire early or later than the average. You want more control about how and where the money is going to be invested, or you've got a larger pension pot and that may need more specific or bespoke investment management. So here's a summary of some of those practical steps. You need to review your asset allocation regularly and adjust the risk the closer you get to your retirement. You should do the de-risking between 5 and 10 years from your retirement date. You need to build and maintain a cash buffer of 1 to 3 years of expenses, and you also need to understand that sequencing risk and how the order of these investment returns can make a huge difference to your pension. You also need to avoid making large withdrawals, especially during market dips, and don't rely solely on your default fund, and you need to consider more suitable options, especially as you get closer to retirement. And you're also going to need to plan your withdrawals carefully around your needs, your expenses, but also in the most tax efficient way possible. Now, if you need some help, just get in contact with us via the channel. Now, I've linked a further 2 videos in this series about why you should be wary of workplace pension default funds, and another about how to master income drawdown. So thank you so much for watching to the very end and for your time and for your patience. As always, I'm going to see you all again next week.